The total asset turnover ratio is a key efficiency metric used to measure how effectively a company uses its assets to generate sales. It provides insight into how well a company is utilizing its entire asset base to produce revenue. This ratio is particularly valuable because it encompasses all assets rather than focusing on a specific asset category, unlike some other efficiency ratios which may only consider one type of asset, such as inventory or receivables. Total asset turnover ratio. The total asset turnover ratio is calculated by dividing a company's total revenue by its average total assets. To compute this ratio, you first need to determine the average value of total assets over a specific period. This average is obtained by adding the beginning and ending total assets for the period and dividing by 2. The resulting average total assets are then used to calculate the ratio by dividing total revenue by this average. Example: imagine a company with total revenue of $10 million over a year. At the start of the year, the company's total assets were $8 million, and at the end of the year, the total assets were $12 million. First, calculate the average total assets for the year. $8 million plus $12 million / 2 is equal to $10 million. Then, divide the total revenue by the average total assets. $10 million / $10 million equals 1. This means that the company generates $1 in revenue for every dollar of assets it holds. Low total asset turnover ratio. A low total asset turnover ratio suggests that a company is not using its assets efficiently to generate sales. This could indicate underutilized assets or a problem with asset management. For instance, if a company has a low ratio, it may mean that it is investing in assets that are not effectively contributing to revenue growth, or that its assets are not being employed optimally. High total asset turnover ratio. Conversely, a high total asset turnover ratio indicates that the company is efficiently using its assets to generate revenue. A high ratio often reflects strong asset management and operational efficiency. It suggests that the company is able to generate a significant amount of sales relative to its asset base, which is generally a positive sign of operational performance and effective asset utilization. How can companies optimize total asset turnover ratio? Improve asset utilization. Companies should regularly assess their asset usage and look for opportunities to enhance efficiency. This may involve upgrading technology or streamlining operations to ensure that assets are fully utilized. Increase revenue without significantly increasing assets. Focus on strategies to boost sales, such as expanding market reach or enhancing product offerings, while keeping asset growth in check. This approach can lead to a higher ratio as revenue grows faster than asset investments. Dispose of or repurpose underperforming assets. Regularly review assets to identify those that are not contributing effectively to revenue. Consider selling, leasing, or repurposing these assets to improve overall asset turnover. Key takeaways. The total asset turnover ratio measures how effectively a company uses its assets to generate sales, providing insight into asset management efficiency. Efficient asset use. A higher ratio indicates effective use of assets to drive revenue, while a lower ratio suggests inefficiencies. Optimizing assets. Companies can enhance their ratio by improving asset utilization, increasing revenue, and managing underperforming assets. Broad application. This ratio is useful as it encompasses all assets, offering a comprehensive view of overall asset efficiency compared to other more specific ratios.